Welcome. Thanks for joining us today. My name is Mark Friedenthal. I'm the founder and CEO of Tolerisk. We've got a big group today. I think everybody knows the drill. You're all on mute. You can certainly write your questions in the box and we will address as many as possible. Now, this is not a product demo, although we will use some of Tolerisk's charts to illustrate some concepts. If you haven't seen a demo of Tolerisk's fiduciary caliber risk tolerance solution, or if you haven't seen one recently, I highly recommend that you join one of our weekly webinar demos or schedule a private demo for you or for your team. Today's discussion is really math in financial planning. Specifically, it's about how incorporating additional variables allows us to more realistically represent the uncertainties of the future. We're also going to do 3 quick polls, so pay attention and please play along. This should be pretty interesting. Okay. There we go. So, brief history. Starting in the 70s to really about the 90s, financial planning was based on static modeling. Started out with calculators, grew into spreadsheets. This was a constant assumption for portfolio returns and inflation to examine cash flows and financial longevity. So, okay, so this graph is overly simplistic, but you get the gist. If you're using a constant or static assumption for something like growth, and in this example, there's no addition or subtraction of cash flows, but you get the idea. It's a pretty straight line. Okay. How about the second generation? In the 21st century, financial planning models have been dominated by Monte Carlo simulations. Typically, they use a single volatility to stream potential portfolio return paths based on a risk level, and it runs until a single terminus point, single point in time. And so kudos to any of you that recognize that picture of the luxury casino in Monte Carlo, which, you know, I think more of you are probably used to this kind of an illustration, all the squiggly lines illustrating the 1,000 or so different potential paths for portfolio returns that we use in those traditional Monte Carlo simulations. Interestingly, in this particular chart, we originally put 1,000 paths up here, and it was just so overwhelmingly congested, you couldn't even really differentiate. So believe it or not, as congested as this screen looks, this is actually only 100 paths, and it's already pretty congested. Okay, we are gonna move to poll question number 1. So how many of you think the volatility of the stock market will generally be fairly constant over the next several decades? Now, keep in mind, this doesn't mean that the market itself will be stable. It means that you think the level of volatility, the level of variation or standard deviation will be fairly consistent. Okay, I see our results coming. We'll give a few more seconds to let everybody cast their vote. We're going to take a look after we look at your poll results, which I think should be interesting. Then we'll take a look at actual rolling periods of volatility, where we can look at long periods of time. Ryan, I think we've got most people that have voted. We got nice even numbers there. So vast majority of you believe that volatility itself will be volatile, and that certainly jibes with history. I'm going to go ahead and put the next screen up there. So what this shows us is that even over 20-year periods, so pretty long periods, volatility can be very different. So these are rolling 20-year periods, and we see that the low point, the lowest 20-year period in our sample here, has about 10%, a little more than 10% volatility per annum. But there are other 20-year periods where it's well into the teens and even up into the 20s. We see, you know, in one period of time, really about 27%. So this can make a huge difference, as you can imagine, a huge difference in the future distribution of returns. All right, let's queue up poll number 2. How many of you think that the correlation between stocks and bonds is generally fairly constant over time. And again, we're going to look at long periods of time. So how many of you think that the correlation between stocks and bonds, whatever that correlation is fairly constant over time? So we're going to give you guys a few more seconds to register your vote. We'll take a look. And then on the next screen, we're going to look at the actual kind of rolling 20-year periods for correlations themselves. So we'll get an idea. All right, Ryan, I think we got a good sample there. Okay. So as I think you've seen the results. Yeah, I think you're seeing the results now. So 63% felt that correlations definitely move more materially, and 37% thought they were going to be pretty constant. Let's take a look over history. And what we see here is they do vary quite a bit. Now, I'll note here, we used correlation coefficient R, or Pearson's R, instead of R squared. And the reason we did this was to show that in some periods, even as long as 20 years, correlations can actually be negative between stocks and bonds. And so a lot of you weren't surprised by that. All right, we're going to take a look at one more third and final poll. I appreciate everybody indulging us. I think this has been interesting. The third poll question is, do you think that inflation is generally fairly constant over time? And again, we're going to look at long periods of time. So do you think when we look at a long enough period of time, the month-to-month or year-to-year fluctuations end up producing fairly constant results over time? And we're going to give everybody a chance to log their vote. I know we have advisors from probably a wide range of vintage. Some of you may remember inflation when it perhaps looked very different. Others perhaps not. Okay, Ryan, I think we got a pretty good cross section there. So yeah, so in this one, actually, the largest majority here, so 77% said no, you expect it to be pretty different even over a long period. And in all three polls, by the way, the majority was really correct, at least as far as what history has shown us. So here, we're again looking at rolling 20-year periods. We range from a low point of about just over 1% per year inflation for a 20-year period, and it can go to 6% or even a little bit more than 6%, even over a 20-year period. That can make for some very different future cost expectations in a financial plan. So I'm going to pose some other questions. We won't do a poll, but how about mortality? How much variation is around somebody's mortality? Now, I promise, no poll, but let's take a look at some data here. So if you look at the I think I'm going to call them red and blue curves, one is for a 54-year-old, one's for a 55-year-old, and this is the probability or the frequency distribution of mortality over the coming years. It looks like from 0 to about 55 years we graphed this. So we deliberately graphed someone who's 54 and 55 just so they'd be close, but they wouldn't be identical, so you could differentiate them on the screen. What we really want to show is that the call it charcoal gray line, which is the last survivor frequency distribution, is very different. Even if you have two individuals that are the same age and we'll say have the same life expectancy, when you're looking at last survivor probabilities, it is very different. And of course, we can look at people of differing ages and characteristics, and then it gets even more differentiated. You know, this is more relevant since frequently couples are trying to ensure that their money lasts for the last survivor. So it is definitely relevant in that financial planning context. Let's take a look. You know, when we consider not just age, which was used in that last chart, but gender, health, things like chronic illness, body mass, cholesterol, other things that the doctor might be measuring, your lifestyle habits, like if you're a smoker, how much exercise or nutrition or sleep do you get, or your family history. These things can all impact your life expectancy, your mortality probabilities. You know, once a smart advisor told me that the moment somebody walks through his door, now I guess this was pre-COVID, the moment somebody walks through his door, they have above average life expectancy. I immediately thought of Keeler's Lake Wobegon, where all of the children are above average. But here, he made perfect sense. Like most advisors, his clientele have above average means, above average education, and above average access to healthcare, all of which contribute to greater life expectancy. How about risk level? Do most clients keep today's risk level forever? I think we know the answer. I don't think we need a poll for that one. This graph from Russell shows the typical glide path used by target retirement funds. It's a pretty generic solution, of course, in that type of product, but for those without other resources, a generic glide path like this might be very reasonable. But imagine customizing someone's glide path mathematically based on their specific time horizon, their assets, what they save, what they spend across differing tax status and other retirement income sources and personality constraints. We could get much more customized with that glide path. So let's get to what we've all really been waiting for. Let's talk about the third generation. So what does the next generation of financial planning models do to better represent the possibilities and probabilities of reality? Now, I can tell you that Tolerisk incorporates several additional variables to better represent real world data. We're going to go through the sort of the highlights here. So here are the main advancements in financial planning mathematics as we've pioneered in Tolerisk. Evolving risk directive. So our hallmark has been that we measure objectively, mathematically, someone's actual ability to take risk over time. So not just today, but how it evolves. We measure their willingness to accept risk, which serves as an overarching cap when more constraining than their ability to take risk. This allows us to build and incorporate a custom glide path used in the simulation. Now, dynamic inflation paths are used just the way dynamic paths are traditionally used for potential portfolio returns. This allows us to incorporate the sequence of real return risk, not just the sequence of nominal return risk. Now, real returns are generally a better predictor of financial longevity because they account for not only how assets appreciate, but the draw from appreciating expenses. Dynamic correlations between the data series, we looked at some of that. As we saw, correlations can change materially even when looking at a long period of time. Now, incorporating dynamic last survivor probabilities into the simulation process gives us a more realistic depiction of future failure rates. Now, I'm going to switch over to our live site. You'll bear with me a second here. Okay, I'm switching over to the live site here. Hopefully you guys can see this. We're looking at an example I use. I'm not going to go through the intricacies because this one's actually more complex. It's a young couple, common kind of savings and spending patterns. But what I wanted to highlight here, one of the things that can contribute to someone's ability might be non-recurring expenses. Sometimes advisors refer to them as capital expenditures. I use this as an example. It's a little bit exaggerated, but I use it as an example to illustrate the mathematical concept of ability to take risk. This young couple who's in their early 30s is planning to pull $200,000 out next year. So short period of time. It's a huge withdrawal for them based on their resources in a short period of time towards the purchase of a house, right? Perhaps their first house. So we can imagine, even without getting into the nitty-gritty math, we can imagine that this large withdrawal in a short period of time is going to mathematically suppress, reduce their ability to take risk, at least until they get past this event, right? After they get past this event, after they withdraw this huge sum of money, keep in mind the money they have left over, the money they're continuing to save and grow, may have a much longer time horizon. That longer time horizon is going to give them a greater mathematical ability to take risk. So that concept of ability, mathematical ability, and by the way, we use traditional fixed income mathematics as applied to household cash flows, so we can do this objectively, mathematically. It's not just now, but we can measure mathematically how it changes over time. The other thing that may be evident here is that something like this has nothing to do with personality. And this is why the SEC describes risk tolerance really in two different dimensions. They talk about someone's willingness to accept risk and their ability to take risk. So while these cash flows, as well as all other cash flows and assets and income streams and tax status and all those things, all contribute to someone's ability to take risk mathematically, those things have nothing to do with personality. Okay, we're going to keep on going. I just want you to keep this example in mind, and we're going to take a look at some outputs here. So I'm going to move ahead. You know what? On our assumptions page, let's actually touch on life expectancy, which you see down here. So we do start with Social Security data. This is available by age, and it has probability of survivorship each subsequent year. So we can stick with that sort of generic data, but we also allow, as that astute advisor pointed out, we allow you to customize that, and that can make an appreciable difference. So here, you know, Jane is female, has certain above average characteristics, and we see instead of a generic life expectancy of about 81, hers is about 87. But to be clear, this is not saying that Jane, we're going to run this simulation until Jane's 87th birthday. No, this is saying Jane is a 30-year-old female with certain above average characteristics, and she has a probability of surviving until 31, 32, 33, all the way out until age 120, which is as far as the data set goes. So her weighted average in this case is about 87. When you've got two individuals, a couple that's commingling their cash flows, it's important, as we saw, it's important to incorporate last survivor probabilities. And so we do that using, in this case, their customized probabilities. We can mathematically create those last survivor, or commonly called second to die probabilities, and embed that into the simulation. All right, let's go ahead and take a look at a couple outputs just to illustrate some of the concepts that we've been talking about. On our dashboard here, so if you look at our dashboard here, you get the two main outputs that are really designed to answer the most common questions that advisors and planners get. One, of course, is what do we do now? What's the right risk directive? And so the Tolerisk score tells us that this couple should have 30 to 40% in risk or growth assets. We use that standard stocks to bonds kind of ratio as a scoring scale. So 34 is 30 to 40% in risk or growth assets, the balance in some basket of lower risk assets. And the other question you get asked all the time, of course, is what's the probability that they would run out of money, right? In this case, there's a 13% chance that John or Jane Doe, in my example, would be alive after their money's gone. Now, this is actually the deepest metric I think that you'll find in planning technology today. And it's because this 13% contemplates the fact that this 34, this risk directive, is not necessarily constant. It may be evolving. It contemplates the fact that not only are there 1,000 plus paths of potential portfolio returns, but also separate paths for inflation, that correlations and volatilities may also be dynamic. It incorporates those second to die or last survivor probabilities year by year, customized based on this couple's, in this case, age and gender and some of those other characteristics. So it all boils down to a nice simple output, but it is quite robust. Let's take a look at that projected glide path for risk. So on this, I'm actually going to take off the projected Tolerisk score. This is the projected Tolerisk score through time. It's that custom glide path that was so unique to this particular client. The blue line or curve, I suppose, as a better descriptor, this is their mathematical ability to take risk moving through time. Today it's a 34. We saw that number. That was also the Tolerisk score, because clearly this is the constraint. Now we see next year that ability, that mathematical ability, bottoms out. And it's not a surprise. In fact, if you look in the box there, you'll see non-recurring expense by house, $200,000. So it's not a coincidence that the lowest ability they have to take risk, at least for a very long time, is right before they're pulling the huge withdrawal out next year. Now, after that, we see their mathematical ability to take risk goes way up, at least for a while in this case. I put a lot of other intricacies to make it, you know, look a little more interesting. So I have college, I have looks like selling a business, things like that. Now the green line, I didn't show it to you because again, it's not meant to be a demo, but the green line is where we set the cap. I based it here on the average of their two personality scores, but you actually have some flexibility to lift it or lower it based on your dialogue and experience with the client. So that Tolerisk score, the projected Tolerisk score through time, that custom glide path, it's rooted in their ability to take risk mathematically, but it's subject to that cap. So part of a fiduciary risk assessment is that you're never going to want to recommend that somebody take more risk than they're willing to accept, even if you can demonstrate they have the mathematical ability to do so. Now, this is a really powerful illustration. It's a very popular one to include in Tolerisk reports because this showcases to the client how diligent and custom the advisor's risk management process is. It's been tailored to them, that this advisor is going to be with them through all of these different events throughout life. So this really drives confidence in the decisions that the client ultimately makes. And that confident client is really less likely to make a behavioral mistake. They are more likely to exhibit better general retention, and confident clients make more referrals. So I think that probably certainly contributes to why this is so popular. I'm going to show, let's see, I'm going to show one more here. I'm going to go to the scenario analysis page. Now, this can be overkill for some clients, but it's a nice illustration for us today. This actually gives, for a specific risk level, at a specific moment in time, it gives the probability of success. So it's a simpler representation. And it can be useful if somebody's choosing between risk levels, or somebody's trying to better understand how their failure might be directly related to how long they perhaps could live. So it can be helpful to have this. But what I wanted to show you really was something specific. So in this couple's case, we said today's risk level is probably going to be between 30 and 40% in equities or other risk or growth assets. So let's look at the 30/70 row and the one below it, the 40/60. And I'm just going to come out to age 90, just arbitrarily. So again, no bearing on whether the client would be alive, but if the client's around, we think there's a 70 to 75% chance they would have money with the risk invested in that range. Now, that's a static risk level. What about if we account for the fact that we think risk is going to be pretty low until this couple gets past that large withdrawal for the house, but then it's going to go up for a while, and eventually we think it's going to come back down? That's the dynamic risk level. That's this bottom row here. We use that projected Tolerisk score that's unique to this client, and we can see that at age 90, there's actually an 88% probability of having money at age 90. It can be very different. So it's just a nice illustration where incorporating a dynamic risk directive can be very different. Won't necessarily go up, by the way, but it can be different in certain circumstances. All right, I am going to actually go back out here, and we're going to pull up a really simple example. Let's go here. Sorry. Let's go to risk assessments. I'm going to pull up a super simple example here just to illustrate the concept of last survivor. So I'm going to go here to the ability section, and we'll say Bill is 65 and he's retired. And Bill is going to draw $3,000 a month, and we'll say Bill has $1 million. Okay, I'm not putting anything else in, just to keep it ultra simple. Since we didn't give Bill a personality profile, we're just going to say he's a 60-40 kind of guy. And we're going to leave the generic life expectancy assumption. So I am going to hit save and submit. Very basic. So Bill's Tolerisk score is that 60. Bill's got a 10% probability of outliving his money. Again, super simple example. Okay, let's go back and let's change it. This is what I wanted to illustrate. Let's give Bill a spouse. Bill suddenly and miraculously got married. Not even going to worry about Bill's spouse's name here. Let's say Bill's spouse is the exact same age and Bill's spouse is retired as well. Okay, we're not going to change anything else. So Bill and his spouse still have the same $1 million, and they're drawing $3,000 a month. So we changed nothing. Now imagine Bill and his spouse are the same age. We're going to say they have the same life expectancy too. So we're just going to isolate the impact of having two people, the probability that at least one of them makes it to a more advanced age. This was the illustration I was going for. So let's take a look. So here, we're changing nothing else, just having two shots at an advanced age. There's actually a 16% probability that Bill or Bill's spouse would be alive after their money is gone. So it goes from 10% to 16%. Obviously, differing characteristics can make that impact smaller or larger, but you get the idea. Okay, enough about examples. I am going to go back to a couple more slides. We're almost done here. Let's see here. There we go. I think we already covered this one. Oh, here we go. A couple of frequently asked questions. So who uses Tolerisk? So advisors seeking a fiduciary caliber risk tolerance assessment, mainly to drive client confidence, retention, referrals. Certainly those in a corporate role use it for a large part because of the added compliance support from demonstrating something that's more rigorous, more diligent. What about enterprises? How can enterprise use Tolerisk or harness the power of Tolerisk's third generation of financial planning mathematics via API? Well, enterprises can use our user interface. They can even get a customized version of it, or they can access our infrastructure through our robust API. Technology providers or technology users, such as financial planning vendors, can utilize our robust mathematics. Robo-advice solution providers, record keepers or record-keeping technology providers, or just your own internal corporate technology tools. Another question we get asked all the time, of course, is, are there discounts for FPA members? Absolutely. Tolerisk is a proud member of the FPA's partner program and vice versa, and you do get an FPA member discount. Ryan, I know we've had some folks that have been pretty patient. Maybe you can help us and address some of the questions that people have, and I'm happy to talk to them as best I can.
Sure. So one question that came through a couple of times in a few different ways was just about other integrations. People are asking a number of different other technologies, asking if we integrate. So maybe you could just overall talk about the integrations that we currently have and are working on.
Yeah, absolutely. So the existing live integrations include Orion, Black Diamond, Redtail, Wealthbox. There are a few others that are in queue as well. Now, for an enterprise solution, we can integrate with any of your other technology, of course, but those would be for the solo advisors or the groups of advisors, and it works, right turnkey. So that's a great question. I appreciate that. We also, by the way, allow, even at the individual advisor level, we allow you access to our API key that's specific to your subscription. So that allows you, if you want to integrate that with something else you have, you could go ahead and do that integration. Now, you'd obviously have to have access to somebody with some type of light coding skills that could do that integration, but that can be done for you. Great. What other questions do we have, Ryan?
While we were going through the screen, somebody asked about the Tolerisk score and what that number meant, what it equated to, and when they're picking a portfolio for their client.
Yeah, great. We did address it, but let me, I probably didn't address it early enough. So let me make sure that we've covered it. So the Tolerisk score, we use an industry standard scoring scale to keep it easy to communicate with the client. I know there are some vendors that kind of invented their own proprietary made up scoring scales. While there's nothing wrong with it academically, we find advisors have an easier time communicating these to clients. The Tolerisk score is simply the numerator in a typical stocks to bonds kind of ratio. So if you get a score of 60, that means a risk level of about a diversified 60-40 kind of portfolio. So we would say the 60 represents the percentage of the portfolio that should be invested in risk or growth assets like equities or alternatives. So we're certainly not telling you how you need to allocate specifically. We're giving you that barometer so that you can help the client select a portfolio at an appropriate risk level and have a process for that to evolve, so that as you continue to work with this client, you have an objective process to recommend changes in the risk directive as the client's circumstances change. And that's really important as well. Good question.
And the final question, before I say that, I'll say it was nice that there was a few current users actually on that reached out and said hello. And we appreciate them being on the call. Also, the last question was just really about discount program. People asked if you had mentioned being part of the FPA's program. Given that we have our own program that lots of different firms are part of, figured we could address that as a whole instead of going through each example.
Yeah, absolutely. So our integration partners are all in our partners program, and they can all give you a code that will provide you a discount. There are a number of others too. So many popular custodians, other popular technology vendors, and trade organizations. And you can just check them out at tolerisk.com on the partners page. Most of our partners are featured there. There are a few that aren't. So if you see your favorite custodian and they're not listed, there's a good chance that they still can provide you that discount code, and you certainly can call us or call them we'll let you know who's if they're in it or not, or they can provide it to you directly. Great question. Ryan, sounds like that was that it, or do we have any other?
One more just came in right at the end about the questionnaire. Obviously, you didn't go through the questionnaire as part of this, but
Sure.
Somebody asked about what is the questionnaire that you use for willingness? Obviously, we talked more about ability.
Yeah, so we use what's called a psychometric profile. We didn't invent this. It's been around for many decades, and it's been used in this context. We find that it's most effective because it's a general measurement of an aspect of personality. In this case, we're measuring how risk-seeking to risk-averse somebody is compared to a large population who's taken the same exam. Perhaps you've seen psychometric profiles that measure other elements of personality, how introverted or extroverted somebody might be, or how optimistic or pessimistic somebody might be compared to a population. So it's more general in nature. It tends to be more stable than things that are measuring something short-term, like preferences. Somebody who's measuring your short-term preferences, by very nature, they're very susceptible to change based on recent experiences. The other thing that is really so powerful here by measuring risk tolerance in 2 dimensions, interestingly, we find it's the ability, which is so unique to Tolerisk. It's the measurement of ability that often engenders that confidence to stick with the plan. So even though that might seem like a psychological component, we want to help somebody avoid making a behavioral mistake, it's often showing them the customized mathematical expression. That's what drives that confidence. We find empirically from our advisors, our users, that if they suspect a client is panicking, they're not going to re-administer a personality profile, and it's not necessary, and the client's not asking for it. They'll go in and they'll open up that ability section and they'll say, are you still retiring at this age? Are you still saving this much and spending this much? Are you still going to put your kid through grad school, or whatever that case might be? If objective circumstances necessitate a change in risk, if their ability mathematically has changed, then that's an appropriate time to make those changes. But it really tends to insulate somebody from the potential behavioral mistake of retaking a personality profile, especially one like some other tools out there that might measure short-term preferences, which can really, as my mom would have said, have you close the barn doors after the horses have escaped, right? Somebody calls in a panic. If their advisor is measuring just their personality and just their short-term preferences, well, lo and behold, they prefer less risk and reward. And so if the advisor then says, okay, this is how you scored, we'll move you into a lower risk portfolio, well, obviously that's happening after that market event has transpired. So that's what I think advisors work hard to avoid, and not only using a psychometric profile, but using a 2-dimensional approach really helps clients avoid those behavioral mistakes. And they
Mark,
exhibit better retention. We got another one?
We got one more question that
Sure,
just came in, which is, what's your background in both behavioral finance and in the use of this technology?
Great question. So my background's really in applied math and risk management. I was a Wall Street guy. I won't go through my whole resume, but I managed 100 billion at Citigroup and some other large trading desks, and built a lot of trading and risk management models in my career. As it happens, my wife is a psychologist. She has her PhD. She's also a certified behaviorist, and was very instrumental in assisting me when it was time to create that psychometric profile. We conducted an academic study to make sure it met academic rigor and standards and things like that. So I don't personally have the background in behavioral psychology. I might be an amateur behaviorist, perhaps being married to a psychologist. My life is perhaps a case study, but in any case, but she was involved and helped us steer the right course there. Okay.
That's all we have, unless anybody else has any final questions.
So in conclusion, when we incorporate evolving risk, dynamic inflation, dynamic last survivor mortality, we more accurately represent the probabilistic distribution of potential results. This drives confidence in the decisions that clients make, which helps reduce those behavioral mistakes and increases retention and referrals. Financial planning is about providing reliable information. It's also about instilling confidence, which helps people stick with their plan and their advisor. So from the solo practitioner to large groups of advisors, if you're looking for a fiduciary risk tolerance assessment process, we invite you to join our weekly webinar or schedule a private demonstration for you or your team, or you can certainly email us, sales@tolerisk.com. If you'd like to see Tolerisk's third generation of financial planning mathematics built into your other technology through API, reach out to us, integrations@tolerisk.com. Also, I'll mention that Advisor Perspectives, I'm sure many of you read that fine publication, they actually published a piece that I wrote this week on this very topic. So if you're looking for more information, just take a look at Advisor Perspectives, and you might find that interesting. Thanks so much for joining us. I really appreciate everybody spending their time this Thursday afternoon, and I hope you all have a wonderful rest of the week. Thanks so much, folks.